In this video, I want to go over the different types of market structure mapping and structure breaks and how to identify structure breaks with clean-cut examples so that you know how to utilize each type so that then you can go ahead and backtest them and figure out which type is right for you. And as a quick refresher, type number 1, we're going to be mapping market structure using candle bodies, and we'll identify a break of structure using candle bodies. So a break of structure will occur when we get a break and close above or below a high or low. In type number 2, we're going to be mapping market structure using candle wicks, and we'll be identifying breaks of structure using candle bodies, so looking for a break and close above or below a high or low. And in type number 3, we're going to be mapping market structure using wicks, and we're going to be identifying breaks of structure also using wicks. So let's take a look at an example on US dollar Japanese yen, and we will start by using the identification type number 1. So if we just start with, we will start with this bit of price action. We'll ignore this amazing drop that we've seen earlier on today and just focus with the most recent price action because the concepts still remain the same. So the first type of market structure mapping is based on the bodies of the candle. So we can see that price has dropped down, has put in a low, and it is pulled back up, creating a lower high, this high and this high. So this high is lower than this high. Now we can see that price wicks down on this candle, comes back up, and then we actually break and close, and the next candle also closes underneath this low. So what we can gain from this is that our new low of this range is on the low of these candles here on the bodies, and the high is on the high of this candle. And basically what we would do is now just wait for price to track forward. So let me actually just use bar replay and do a couple ticks. So we can see right now we are creating lower lows and lower highs based on market structure. And we can now see if we just advance price, we're caught in the range, and we've broken and closed above this high here. We can look at price and see that price moved up. We didn't break the high. We pulled back down, and then we pushed back up, breaking and closing above that high. So we can now move our low to the close and open of these two candles, as this is the bodies of the low that then broke structure. And we can see that our new high is right here, but we haven't actually seen price pull back yet. So we can either keep moving the high as price continues pushing up, or we can just keep it at the prior high just to give us an indication that price has now broken this high here, and we're waiting for price to continue up, push back down, and continue up if we're going to do a bull trend, or maybe we get a fake out and then we start putting in lower lows and lower highs. So what we'll do now is we'll just keep moving price forward. We can see that we've created an actual high. We started to pull back, so we can actually denote our high with the candle bodies. We can see that price has moved down. It has spiked the low, essentially grabbing the liquidity that rests below this low. We can see that price created a high here, created a lower low here, it pulled up, pulled down, and then it pulled up. So people that would be looking to buy support, for instance, would likely buy here with their stop just below here. This is basically purging any liquidity, and then we can just keep playing price forward. We can see again, price spiked the low, but we haven't closed below this low, so we're still in bullish market structure. I'll just keep playing price forward a few more, and we've now broken and closed slightly above this high. I'm going to advance one more candle just to see what happens next. We can see we get a rejection. Now, we can see that price has created a high, very insignificant high compared to the previous high, but a high nonetheless. So what we can do is we can then move our low to this low point, and what we can see is price has gone down, it's gone up, it's gone down, and it's gone up. It did pause here, but I would not necessarily use this as the low, just because this is more of a pause in the market before price continued pushing up, where this is actually a truly defined low. And what we can always do as well is just look on the line chart, and basically just look at the prominent swings that we're seeing. So we can see that this is a very clean and clear looking low, where this one is more of just a pause in the markets. We can see that through the candles, but the line chart really shows that clear delineation. We can see that the low that we used here is clear, the high that we had here, the low here, and the high here. So if you're ever wanting to get additional confirmation of kind of what price is doing, the line chart is a great resource. So now if we go back, we'll do just a couple more. You can see that price still hasn't broken the high here, so we're still caught in this range. You can see now price has broken the high, and we carried on. And again, if we go to the low, we can see we have an actual prominent swing. So in this case, we can use this low as our low, and we can navigate this as our new high, again, on the bodies of the candles, not the wicks. You can see prices just continuing on to the upside, and we'll just see if we get a pullback. Until then, we're in a clear bull trend, creating higher highs and higher lows. Now we can see that we've created an actual pullback. Now price is pulling back, more than likely to put in a higher low before moving to the upside. And what we can see is if I just drag this line, we still haven't invalidated structure. We're still caught in this range. The substructure is creating right now lower lows and lower highs, which is a component of a bear trend. Which we would very clearly see on a 15-minute, 5-minute, or any lower time frame chart than the hourly chart that we're on. And we'll just see what happens next. And we can see we wicked it. We haven't actually broken and closed above this high here. So this is the range that we're still trading in. Basically, this is a test of a supply, as well as just more or less testing the resistance that would be created at this level now that we can see that we're putting in lower highs and lower lows. We tap into the high, but we haven't closed above it. So we're still caught in this range. You can see we've wicked it yet again, but still, we're still caught in this range. We haven't actually closed above. Just hit play, and we can see now we've finally broken that high, closed above it, and continue to make higher highs. So what we can do is we can track and find our new low. So initially we can put it here, but we can use our handy dandy line tool just to see this is a prominent low for the most part. We do see that there's a little bit of consolidation. So if we're going on true swing lows, we can actually look here, but we also can use this point here as we can see that price did base here. In this case, this would be up to entirely your judgment on what you would value as a low. We can see that price did pull back and go again. When we go on the line chart, we can see that we do get prominent pullbacks, a clear low here. So we can use that as our low of this range. And it has a lot of confluence just because we have a lot of candles that are basically closing in and around that price level. And what we can see is price has created a high. Go back to the line chart, we can see we created that high and we've actually broken it. So I got a little bit ahead of myself when I was pushing forward. So we can move price to the low there and the high there. And again, can use a line chart and just see that's a clear low that broke this high here in the structure. Finally, we'll just kind of carry on. You can see we've spiked the low here, we spiked the low here. We haven't actually closed below it, so we're still in that uptrend. And we can see again now closed above the high, making our new high right here. And again, we can refer to our line chart and just look at where a clear low has formed, where we see an actual dip down in price. We don't want to see something kind of like that because that's not really a low, where we get something like that or that, something like that. We get clear lows. Price is actually taking the time to pull back and continue on because we know a trend goes, creates a high, creates a higher low, creates a high, creates a higher low, creates a high. And it does get a little complex. As we can see, it doesn't just do something like that. It will do other things in the middle and still stay within a range before it actually truly goes, and we can see the highs and the lows that we would be using as reference points as we carry on in structure. Now let's take a look at example number 2, which is using candle wicks as identification of structure and using candle bodies as breaks of structure. So what we'll do is we'll use this exact same bit of price action that we looked at in the prior example. So we can see that we have a high and a low right here. You can see price has impulsively moved to the downside, broken some structure to the left as well. And we will just move price forward and see what happens. We're monitoring this low and this high, and we're using the wicks in this case instead of the bodies. We can see price is approaching our low and still ranging within this spot. And we can see on the previous example, we considered this a break of structure, creating a lower low. But in this case, because we have this overall wick, price didn't actually come close to that nor break it. So we're caught in a much larger range. So just play price forward. And what we can see, the key difference right off the bat, is that price is caught in a much larger range. And we are tracking more or less on the low of this range. What we can do from an initiative standpoint is understand that if we were to drop down to say a 15-minute chart, we would be breaking structure, creating a low here. our high would be in this location. So we'd be looking at a structural break here, a test of the lows here. So what we can do with that information is understanding lower time frame. We can see that the trend is created on the lower time frame, and then it eventually starts to build on the higher time frame. So what we can do, we can create substructure within that and look at that we've created a low, we've created a high, created a higher low, we've created a higher high, but we haven't actually broken it. So we can just monitor this high, for instance, just to see what price does, and then we can get a general idea of what price action is thinking. And what we'll do is we'll just play price forward. What we can see is now we've broken and closed above this high of this structure, which also broke above this high. Again, if we were looking at just this entire range of price, we would more or less just be sitting on our hands, looking for a sell opportunity potentially up at this point of interest, or for price to continue breaking down, creating lower lows and lower highs. So what we can do then in this case is we can map out structure a little bit and call out this low right here as the low that was created before price then began to trail to the upside, and we can use this as our high and see price then moving a little bit away from this high. We can see that we've created a true high here, and we'll see if we get a true pullback. Now, if we're looking at this little bit of price action right here, yes, we did pull back from the low, but this is all part of one impulsive leg. You can see that the highs are still being respected. We don't get a true pronounced pullback, similar to if we were looking at this down move, if you were questioning why this high wasn't registered, because this is all part of a down move. We didn't get a true pullback and then a true lower low being formed, having this as our lower high and lower low. Small detail, you can look at this entire leg as one impulsive leg to the downside, similar to this leg here. And we can already see clearly from this example number 2 to comparing it to example number 1, we had a lot more changes of structures when we were looking at the bodies of the candles versus the wicks of the candles. And we're looking at overall the volatility and the range that's being created within the wicks when we factor them into price action. So something to consider when you're figuring out whether you like one method or another. And we know that at some point we're going to break this high from the prior example, but we can see we've wicked this overall high, but we haven't closed above it. So we're still caught in that range. Still testing the overall highs, but not actually closing above it. So we can't really count these as higher highs just yet. And we can see there, finally, we have a break and close above structure. So what we can now do is move our low and our high to better categorize the market. See that we've created a high with this wick, and we've created a low with this wick. Again, similar to the other example, the previous example, we created this base of price when we were using the bodies of the wicks, and we can see that price has clearly gone down and gone up. We can see that we don't see it with the line chart because go to my settings, you can see that the line chart, the type is set to simple, and we're using it on the close, but you can navigate looking, if we were looking at the overall low, we can see that that low is actually in line with that. We have the close, you can look at the high, which is where we have our high placed, and then you can start to look at more averages and different ways of looking at the overall line chart being created, looking at highs plus lows divided by 2, taking the average, the highs plus the lows plus the close, taking the average of all three, and then taking the open, the high, the low, and the close and divide it by 4. So taking the average and just different ways of looking at price. And we'll go back and just play price forward just a little bit more and see what happens. You can see testing the highs, we have broken and closed above the high once more, and what we can do is actually navigate our low here, because again, we'll go here, we can see a clear pullback. But in this case, this wasn't a great pullback, this was definitely a more prominent low to use, so we can actually utilize that low as our low, and this is our high now, and we can just see price range within. We've just barely broken and closed above that high, and we can now adjust our low here and adjust our high right here. And again, we'll look at the chart, the line chart, and we'll see that we do have a clear low being printed, a clear high being printed. So we know we're on the right track in terms of utilizing the highs and the lows with that manner. We can see we've wicked this low, but we haven't actually broken it, so we're still in that overall bull trend. And we can see price again wicks the high, but doesn't actually close above it until we get this candle right here. And that is, in a nutshell, mapping and identification of breaks type number 2. And again, like I said, with the overall range that we were creating on here by looking at the wicks, all of this would have just been interrange, but because you understand that, you can still look at what price is doing within that range. So it's a little bit of flexibility in there. Once you get a high, you wait for that high to break, because then you can see on a lower time frame that we broke that range high, started creating higher highs and higher lows, higher highs and higher lows, broke structure right here, created higher highs and higher lows, and so on and so forth. So if you were simply just looking at this larger range, you'd be sitting on your hands doing absolutely nothing. Whereas if you understand market structure and the substructure within that range, you can still look and still trade the overall price action that we're seeing within the range itself. So we can still look for counter trend trades that are within this overall range and still find opportunity within that trading range. And now let's look at the third and final type of mapping market structure and identifying breaks of market structure. And that's based on the wicks as a means of mapping market structure and utilizing the wicks as a break of market structure. So again, we're going to start with the exact same range. We're going to map it out just like that. And we can see in this case, right off the bat, we created similar price action that we would have seen in the prior two examples. Again, with the body, we broke structure here, creating a lower low. In the second example, we ranged around the low, and now we're just ranging in between this overall larger range. So what we can do again is take our initiative and basically just look at price action between that range and definitively look at price action from that lens. So what we can see is we've broken this high with this wick, so we would now consider this a higher high. So we can now plot our lower low, and if I just take price back, here we can see that our low that we would be looking at, price went down, it went up, but it didn't break this high. It went down and then it went back up, breaking this high. So this is our higher high and this is our higher low that created that break in structure. Now we can just play price forward and we can see that we have now broken the low, creating a lower low. The high still remains, and then we can just keep playing price forward. You can see we're starting to pull back, and in this case you would be wondering if this is a higher low or if we're going to print a lower high and then continue, especially given the fact that we are in an overall bearish price leg. Let's keep playing price forward. We can see we've broken this high, so we can track our low to this candle right here, and we can plot our high right here. And in this case, we actually did break and close above this wick. In the prior example, when we used this high, we didn't actually consider this wick. We actually broke structure down here. So it's a little bit of a smaller break in comparison, but still a break nonetheless. And we can see price then continues pushing to the upside, creates a little bit of a counter trend move. But again, this is all part of the bullish impulsive leg. So we can see we've created a high here and created a true pullback, something that's actually conclusive. And we can see that price is now potentially forming a higher low. You can see right here, we have broken this high with this wick. So this is our new higher high. And we can track back to basically where price pulled back. We can utilize this as our low because it's a prominent swing low of this move. See that price went down, it went up, it went down, and then it went back up. So we can mark this high on here and carry on price yet again. And we can see again that we've broken, and in this case closed above this high right here. So our new high would be right here, and our low in this case would be this candle. As price has gone up, it's created a low and then gone up. See, we've pulled back and we've gone up, so we can adjust that. Pulled back, broken structure again. So in this case, we're seeing price tightening up. And like I said, we're getting an actual true pullback versus a situation like this, for instance. That's not a pullback. That's just this wick created a range. This range was filled by these candles. The momentum continued. This wick created liquidity and filled the range with the prevailing candles. Just barely breaks the high with the wick. We can see that price goes down. We go up, we go down. See that on a line chart as well. Smooth it out a little bit, get a cleaner low printed, and just keep playing forward. Now we have created a new lower low and a new higher high. So in these sort of situations, it can throw you off in terms of seeing now we're creating a lower low, but now we've created a higher high. What we can see is we've just set ourselves up for a new low to be created, and then we've proceeded to create a new high and then proceeded to blast off. And like I've said in the initial video, all three methods, they work, they're effective, and it ultimately comes down to what makes more sense to you. You can see that there's pros and cons, all three types. Looking at the first type, you can see that we were able to better understand this trend and not get caught in this large range. But understanding that we were under that range, we can look at the substructure. Overall, keeping in mind the larger bias, but knowing that once we create this impulsive leg, we're more than likely going to pull in some sort of lower high before we start to push down. So we know that price is more than likely going to move to the upside. If I look in the overall 4-hour time frame, you can begin to see it a little bit clearer that we created this impulsive leg and price is now pulling back up. We can see we have a point of interest that we could be looking at to look for sells. So it's only natural that price is going to fill in this inefficiency. It's going to come up, tap this, and if we get buy-ins from institutions, that would be where we would start to see price drop again. And we can see that we broke structure here, whether we look at this point or this point right here. We can see that we also have a point of interest that price tapped into, which is why this leg right here was created. We can see that reaction right there. We can see that we created this range overall that created a lower low, and this is our high here. Price then pushed down, and because this was a momentous move that broke structure, we have an order block on the 4-hour that we could be looking at for sells. We can see price taps into it with a wick and then pushes down. We can see that this move created a lot of inefficiency on the 4-hour, which needed to be filled, which is why we're starting to see a pullback overall on the 4-hour chart, and we're able to look at that in a little bit more detail on the 1-hour chart. And again, we came to the same conclusions overall using the different types of market structure. The only variance with being number 2 and number 3 was that we had to essentially utilize substructure to be able to accurately identify this bit of price action, whereas with number 1, because we were using the bodies, we can see that price allowed us to just follow that trend overall. And then a final remark when it comes to market structure is understanding that market structure is a tool that we use to understand what is happening and frame our trades. We're not trading market structure directly. We're using higher points of interest to understand when we see market structure breaks, and we can see right here, for instance, price did break this. But if we were looking at it in a different light, we can see that we created a high here with method 2 and 3. We can see that price impulsively moved to the upside. And if we were using method 1, we'd see that we put in a higher high and a higher low. We then broke down and basically printed a low down here. Our high would be right here. Then we started to switch bullish again and push to the upside, basically creating higher highs and higher lows. We broke structure down here, and we can see that this was the start, and we've identified the order block. If we look at method number 2, we can see that price created a high. We broke that high here, creating higher highs and higher lows. We didn't necessarily break the high here, we just wicked it. We would have had a low right here. We broke that low. We can identify the order block still in the same light. And then finally, if we go to method number 3, we created a high. We broke that high, creating a higher high with the wick, which we would denote this is our low. We would have this is our high. We can see that price broke this low. This would be our new high. But then we created this low. We broke it. So this would be our new high. We can see that we broke here, this candle, this low here. So our new high would be here, and we can see that we broke. This would be our new high. Our new low would be right here. You can see that we then created a high here that broke with this candle. Our new low would be here. We broke that high there, created a low here. We get this sort of candle maneuver where we pull back, but we also create a new high. So this would be all part of one price leg. We create a high, just barely break it. You can see if I zoom in just a little bit, we can see that we break it with this candle right here. So our new low would be right here. We get a break of market structure and a move to the downside that breaks many lines of market structure. We are able to identify our order block. So either way, it doesn't matter which way you are identifying market structure, you still come to the same points. You get to the same point of interest, especially when you look at this large impulsive move to the downside. You can see that we have that overall order block that was created in this point, which we'll be using as our higher time frame point of interest. And then we see price taps into it and continues to sell off. And we're still utilizing market structure regardless of the type of identifying how we're mapping the structure and how we're identifying the breaks of structure. We still get to the same result. We can see that price is still creating higher highs and higher lows. We break structure, whether the structure is down here, it's up here, or it's up here. We identify the order block because we broke in structure, we've seen the momentum jump into the markets, and then we would still be looking for price to retrace back to that order block and then continue to the downside. So I hope this video has helped clear up any confusion that you may have had surrounding the highs and the lows. And I urge you again to backtest, figure out which method makes more sense to you. They can be a little bit confusing initially on how you want to identify highs and lows and how you want to identify breaks of structure. Depending on where you are in your Forex journey, you may have learned different ways of doing it, and I urge you to pick, again, the method that makes the most sense to you, because at the end of the day, you're going to arrive at the same result regardless of how you're identifying market structure, because you're going to still be able to identify the higher time frame points of interest that we should be identifying in order to find trades, because we are trading order blocks and using inefficiency and market structure to understand where price is more than likely going to pull back to and react off of before moving in a certain direction. And then we can frame out trades and utilize market structure to understand those moves and just classify and categorize those moves into an understandable framework.